Okay, good afternoon and welcome everybody to our 2022 results briefing. We'd like to welcome you all to Fairmont Hotel, and to our virtual attendees, welcome as well. So we'd like to start off with our presentation. So in terms of our financial highlights, we still see continued strong results across core businesses. Earnings are broad-based and continue to remain diversified. We still maintain or would still see positive operating jaws coming from higher revenue growth vis-a-vis managed OPEX growth. Our full-year ROE is at 13%, exceeding our pre-pandemic level, and our fourth quarter ROE has gone beyond 15% compared to 14.8% in the third quarter of last year. Our balance sheet remains solid with very comfortable capital position. In terms of asset quality, there's a continued improvement. Our NPL ratio continues to trend downwards, while our coverage ratio continues to increase, and we ended last year with about 166% NPL cover. Lastly, we've increased our quarterly cash dividends from 30 centavos per quarter to 75 centavos per quarter to be able to give more to our shareholders, and also this is more consistent in terms of the bank's current financial performance. Now, moving on to the fourth quarter highlights. So we've seen a record net income of 17.1 billion. This is a 65% growth compared to the fourth quarter of 2021. And again, translates to a return on equity of 15.3% for the quarter. Our margins improved to 4.37% as of the fourth quarter, and that represents a 36 basis point year-on-year growth in NIMs. And our cost-income ratio for the fourth quarter is at a two-year low at 55.6%. So in terms of our financial performance for the year, so our full-year net income is 57 billion. That's a 33% growth compared to 2021. Full-year return on equity is at 13%, but in terms of going concern, again, the fourth quarter ROE is beyond 15% already. And that's our carry-forward profitability into 2023. In terms of net interest income, it was driven by expansion in our earning asset base. We saw loans and our securities portfolio growing substantially. They are the major earning assets for us over the past year. And funding came primarily from deposits, a combination of CASA and time deposits. In terms of non-interest income, we saw strong performance in fees, and this came from different businesses, ranging from payments to credit cards to loan fees. And it's a strong, I guess it's a strong result considering also the reopening thematic that we saw in 2022. On the treasury side, we saw an increase in our trading and FX gains, and this was primarily flow related. So PPOP, I think a strong performance at 23% growth. In terms of provisions, we more or less just maintained our pace of provisioning at about 60-65 basis points. And again, this is despite the continuing improvement in the NPL ratio that we have seen. Our NPL ratio at below 2%. We've maintained our provisioning levels in an effort to build up a more comfortable cushion against the next black swan event or the next unforeseen loss event for us. And that reflects in terms of our coverage ratio at 166%. Next, please. So in terms of the balance sheet, again, as mentioned earlier, the major earning asset growth we saw was in the loan portfolio, which grew by 9%. Our securities book grew by 17% and now comprises 18% of our balance sheet. Funding side, as mentioned earlier, came primarily from a combination of CASA and time deposits. And lastly, in terms of our capital, we reported a 9% increase in our capital base. In terms of book value per share, that also translates to a 9% improvement. Our book values of year-end is at 86 pesos. For the loan portfolio, the fastest growing segment was consumer last year at 14%, corporate growing by 7 to 8. And in terms of our consumer portfolio, the faster growing segments were credit cards and mortgages. On the funding side, as mentioned earlier, CASA continues to grow. Year-on-year growth in CASA was 5%. Now, this is a bit slower than what we've seen in previous years. But again, it reflects also the difference in the interest rate environment, where given the large differential in opportunity rates, we've seen some of our clients becoming more efficient in terms of managing their operating accounts. But in terms of cost of deposits, I think at 42 basis points, that would still represent one of the lowest in the industry. In terms of our footprint, we increased our branches by 108 last year, 6 from the commercial bank side and 102 from BDO network. So in terms of margin trends, full year NIMs at 414, but the quarterly trend is shown in the lower chart. So we registered a 13 basis point quarter-on-quarter improvement in NIMs. And this compares to the 18 basis point NIM improvement that we saw in the third quarter. Fee income, as mentioned earlier, broad-based contributions, 24% growth year-on-year. And in terms of the life insurance business, we reported a 4% growth in total premiums. The life insurance business was still affected by the mobility restrictions in the early part of 2022. But I think they've been able to catch up and ended the year on a positive note. For the securities portfolio, again, as mentioned earlier, there has been a deliberate gradual buildup in our securities book, and it now constitutes 18% of total assets. We've kept duration short, still under 5 years, but we're seeing an improved portfolio yield in the process. Cost-income ratio, because of the positive jaws, the reported number for the full year is at 59.4. This here at the bottom, that's the full year number. But if you look at the quarterly trend, for the fourth quarter in particular, our cost-income ratio is down to 55 and 55.6%. If we were to strip out the impact of our high growth businesses like BDO Network and BDO Life, the traditional banking business generates a cost-income ratio of about 52% already. For asset quality, as mentioned earlier, if you look at the lower chart, so continuing downtrend on a sequential basis. So from the peak of over 3% in the second quarter of 2021, we are now down to below 2%. And our coverage, as mentioned earlier, 167%. We're close to where we were during we were at 2019 levels already in terms of NPL coverage ratio. Now, in terms of profitability, looking at PPOP, 23% growth. The full year PPOP is about 90 billion. If we look at the fourth quarter PPOP as something that we carry forward, that's equivalent to over 100 billion in PPOP per year. And again, that represents a strong internal capital generating capability for the bank. Okay. So even if our CET1 ratio may not necessarily be the highest among the peer group, but we do have a very strong internal capital generating capability. And in terms of ROE, again, the full year number is at 13, but the carry forward or the going concern ROE is at around 15% level already. Given our strong internal capital generation, we believe that we can sustain a 3 peso per share cash dividend in terms of a payout ratio going forward. Now, for the last portion, may I ask Dante to give you a brief overview in terms of the macro outlook.
Thank you, Chito. Yeah, just quickly, in terms of macro update, in terms of economic activity, the Philippines 2022 full year GDP growth number of 7.6% exceeded both government and market consensus estimates. Private consumption remained resilient despite elevated inflation. We do worry going forward, however, that persistently elevated inflation combined with increasing uncertainty on the interest rate outlook could weigh on consumer sentiment as well as business sentiment. With regards to inflation and rates, we think that policy rates are poised to remain higher for longer given renewed hawkishness from both the BSP and the US Fed following recent inflation data. We'd like to highlight, however, the comments made by the DOF, the BSP, as well as NEDA that there's a limit as to what monetary policy could do to address inflation worries, especially if these are heavily influenced by supply side constraints. So what are we on the lookout for going forward? Three things. One, we agree with government officials that there's a need to ease supply bottlenecks in order to see inflation come off. I think in the near term, the supply bottlenecks are focused on food, such as sugar and vegetables. But over the medium term, we think power generation is also an issue. Second, we're tracking as to whether the recovery in private consumption in the second half of 2022, in particular, could be followed by a similar recovery in investment spending. Based on data we track, we sense that some corporates are holding off on capex spends until they see some stability in the interest rate environment. So we'll see how that goes. Third, last but not least, we're expecting or we're tracking policy execution from the government. I think in the Philippine Development Plan that was released recently, the government set some fairly ambitious GDP growth targets over the medium term, but at the same time, they're signaling that they're going to prioritize fiscal consolidation, bring down the fiscal deficit, bring down the public debt levels. So if the government is going to carefully manage spending, but at the same time maintaining aggressive GDP forecasts, the only way for them to achieve the growth targets is to, I guess, loop in the private sector, mobilize private sector via PPPs, and also increase the share of Philippine FDIs, given that FDIs are increasingly being rerouted away from North Asia and into ASEAN. So again, these are things that we're tracking closely.
Thank you, Dante. So in terms of our business outlook, okay, in terms of the intermediation business, we're looking at loan growth this year to be around the 8 to 10% level. In terms of fee income, we believe that there's sustainable growth there, and wealth management will continue to gain good momentum as we expand our coverage into growing our assets under management. On the asset quality side, we expect the trend to continue given that GDP growth is seen to be around 6-7% levels. I think that's going to be positive in terms of the asset quality indicators. And lastly, in terms of the digital initiatives, so we continue to roll out our digital capabilities, and we continue investing in infrastructure, cybersecurity, and operating process. At this point, we'd like to open the floor to questions.
Good afternoon, everybody.
This is Richard Tan. I'll be moderating the Q&A section. So I'd like to start off. There's a question here from UBS, Akash. Questions on capital. Any thoughts on tentative schedule for Basel IV adoption and its impact on CET1?
I think that will depend on the BSP's actual implementing guidelines. So we'll have to wait for guidance from the BSP.
I'll relay the question from Jin Hon of KSC. Okay. Next question is, what is the likelihood of cost-income ratio coming down further with slower opening of branches compared to previous years?
It will continue to go down. The pace actually will be determined by the income side. Because at the moment, the cost-income ratio for all banks, the whole industry, benefited in a big way due to the rise in interest rates.
Okay, we have a question here from Nat of APG. Are we starting to transmit rising rates for consumer and SME book? Or are there any competitive dynamics preventing full transmission?
Yes, we have. I think we've seen the teaser rates for mortgages going up by 150, 200 basis points. And even on the repricing rates for mortgages as they fall due today, the repricing rates are, again, more reflective of prevailing markets. So yes, it has been applied, especially in the case of mortgages. Now, in the case of auto loans and credit cards, I mean, the case of credit cards, the cap has been increase to 3% per month. In the case of auto loans, I think the interest rate changes are not as significant considering that the yields are already at double-digit levels. So it's primarily in the mortgages where we're seeing the transmission becoming more, I think, prominent.
Well, I guess I'd like to thank everybody for coming here and thank you for your questions. They make us think sometimes on whether we're doing the right things. But so far, the only thing I can say is we're facing a lot of uncertainties. Most of them actually are not of our own doing, but coming from the outside, which makes it more difficult to address. But generally, I think the banking industry is healthy. And we, for one, are just preparing for the uncertainties. So there's a little bit of caution in our approach. So again, thank you for your presence and thank you for your questions.
Also, thank you to our virtual attendees. We have quite a number of them who have dialed in for this event. Thank you very much.